Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with Otis. Otis, go ahead and tell the people a little bit about yourself.
Awesome. Thanks for having me, Troy. My name's Otis McAlhany. I'm a PE teacher, head baseball, varsity defensive coordinator, football coach. Also teach personal finance at the school that I work at, and I'm excited to be on the podcast.
Yeah, I'm excited to have you. You have a lot of hats, man. That's a lot of things you do.
I do. I stay pretty busy.
Is that like life in the school system? Is that like you just start with one thing and then they ask you to do something else and then it ends up leading into 10 other things?
Pretty much. Yeah. I mean, I wear a lot of hats. I like to think of it as keeping myself very employable.
Yeah, yeah, exactly. Like we don't need that thing anymore, but he does so many other things. Yeah, I like that. That's job security. So you, touching on that real quick, you mentioned that you do personal finance at your school, and this is a high school, right?
Correct.
So like what kind of, like, just out of curiosity, because you know how everybody always talks about like kids nowadays aren't, they don't teach that in school, or like, they always teach you, the Pythagorean's theorem, but they don't teach you how to write a check. So like, what kind of stuff do you teach in there? And like, what are you doing as your small little part to make sure the kids in your area are at least educated in finance?
So this is actually the first year I've taught this. I call it a Foundations of Personal Finance course. And we start at the very beginning talking about behavior. I'm sure, as you know, personal finance is 90% behavior. It's not that complicated. It's really third grade math. It's addition, subtraction, a little bit of division and multiplication, but it's, ultimately it's third grade math. It's the behavior that is behind the math that is going to make you or break you personally, in your personal financial lives. And then of course, we talk about investing, the stock market, taxes, insurance, banking, pretty much anything that could have an impact on you personally in your financial life, we discuss in one way, shape, or form or another. We'll obviously touch on a little Bitcoin. We'll talk about cryptocurrency at the end. But just really anything and everything that you could do or need as an individual person or a professional dealing with personal finance.
That's super. So, okay. So a couple questions on that. One is, are there certain questions and stuff like that the kids are asking, or like that they seem to be more interested in or less interested in? Are they really receptive to the information? Are they just like, this is adult talk or whatever? And then the second question, that might have been like a part one, part two. Second question is like, did you approach the school with this idea, or did they have a sign up sheet and say, hey, we want to do personal finance? Like, anybody know anything about this, or how'd that work?
So this is my 6th year at the school, and everyone at my school is very aware. I'm very open on social media about my financial journey. I actually paid off $53,000 in consumer debt in 13 months just by grinding and killing and working it all off. And everyone at my school is, again, very familiar with my financial journey and what my views are on finances. And the school, it is kind of, we met in the middle. We've got a parent who's a financial advisor, runs a financial planning firm, and has been adamant the last few years about getting some type of financial education into the school. And then also I have a passion for that. I do run a small business on the side where I've got some financial coaching clients. And then I kind of approached the school and they were like, yeah, we've got a parent that wants it. We want it. We finally have found someone qualified to do it. And then it just kind of started. This is the first year I've done it. It's a senior only class. And it's a great experience. The first semester was good. The second semester is even better. And looking forward to continue to rolling this into next year.
Yeah, that's super cool. So do you think eventually it'll be more broad based? Do you think they'll just keep it as seniors?
Probably, most likely.
Okay. And then so the first question, like, are the kids receptive to it? Do they not care? Or I assume because it's being taught to seniors, maybe it's a little bit more. The seniors are showing some kind of urgency because at the end of the day, I mean, whether you're going to college or being a big boy or big girl right after you leave high school, like this is your last year as a kid, I guess, if you want to call it that way. So I would assume that they're more interested, right?
Yeah, the seniors are very interested. Like I've got a great group of kids. They ask very, in-depth questions. They're interested. Of course, you ask, what are the kids most interested in? The stock market. All kids want to talk about and look into the stock market, businesses, things of that nature. Very interested in credit cards. You could tell, you could see the hamster wheel starting to turn when our very first unit was all about behavioral finance. And you see that, kids are, relaying or thinking about the behaviors that they've displayed in the past, or they've seen their parents or other adults they know. And then, you can really see things start to click when you talk about behavioral finance, which is a major part of being successful financially.
Yeah, it'll be really, really, you said this is the first year you're teaching. It'll be really, really cool. Like you're teaching this, 15, 20 years from now, and like some kid comes back and like that'll be kind of the thing. It's almost like testimonials that you can do is like
Absolutely.
10 years from now, you have, Joe Bob that you taught the first class to, and now he's got his own business and he's really successful. And not saying that all of this is because of you, but a good majority, like you put him on the right path more or less. And he could be like, yeah, I took this class back in 2024, 2023, and here's all the things, and it's really good. And all the other kids, any of the ones that are like skeptical or whatever, this isn't important to me, like he can really say like, hey, look, that very first lesson that you learned, the basics and the psychology of money more or less, it was the foundation of like everything that I did. Now I have a multi-million-dollar business or whatever. That'd be pretty cool.
Absolutely. Yeah, I've already had kids because these are all seniors, so they're either 18 or turning 18, and they're eligible to open a Roth IRA. And I've already had a few kids who work regular jobs after school or on the weekends, and they've already told me, hey, I opened a Roth IRA and I don't have much, but I'm going to put $50 in it. And the wealth multiplier for an 18-year-old is over 100% or over 100 times. So think that $5 is easily going to turn into $5,000 by the time they're 60 or 65 years old. It's just the wealth multiplier at that young age is just so high.
Yeah. So, okay. This is super, like, you're the first one that I've talked to that's done this. And, like, this is a really cool topic for me. So, like, again, two more questions. How do you teach the kids more about like delayed gratification? Because that's so important, especially in the kind of investing that we do. But even for teaching a kid, no matter if they want to be a dividend investor or not, how do you teach them about like it's not about today, it's not about tomorrow, it's not about next year? When you have time on your side, it's about 30, 40 years from now. And teaching that to somebody that's only lived for 18 years is probably a little harder than you might think.
Well, I mean, you break it down like, these kids can relay back to the experiences of their parents and grandparents. Like, there's going to come a time in your life where you're going to be done getting up in the morning and going to work.
Mm-hmm.
It could happen at 60, could happen at 70. I mean, nowadays you got people working into their 70s just because they haven't been financially responsible. They haven't saved for retirement. And we really try to break it down. We talk about budgeting a lot. Budgeting is a major part. A lot of people view a budget as like it restricts me and it tells me what I can't spend money on. When in reality, a budget is the exact opposite. A budget tells your money where to go instead of wondering where it went.
Mm-hmm.
And in reality, there's only three things you can do with money. You can spend it, you can save it, and you can give it. Okay. So there's always that charitable side of people giving back to others, helping those in need. And we really talk about, even if it's just a little bit of today, like these, I've had some of these 18-year-olds say, Coach, I want to open a Roth IRA. I want to, start saving a little bit. I said, if you can just do $25 a month, and you can do that, you can literally go babysit for an hour and make $25. You can just give a little bit of today for a great, big, beautiful tomorrow.
Mm-hmm.
And it adds up over time. When you think about compound interest and the wealth multiplier that these kids have at 18, 19, 20 years old, at 20 years old, if you assume a 10% rate of return, which is what the S&P 500 has done for the last 100 years, a 10% rate of return at 20 years old will give you 88 times over at age 65. So for every dollar they invest at age 20 will turn into $88 at age 65.
Yeah. Yeah, I really like looking at like so I have a video idea that I have like already written. Like the data's already there. I just have to actually do it. And as I don't even know if you can do this, but like if you guys, I remember when I was growing up, it always used to be my favorite time when the teacher would roll in the TV that was like strapped to the little desk thing, and they would roll it in because either the teacher had a long weekend or whatever, and they don't feel like teaching or whatever, but they'd roll that in, and that was always exciting. Now, I guess you guys just have like smart boards and stuff. That's what we were going towards when I was leaving school. But so now I guess you just turn on the projector or whatever. But like the video idea that I have, and like hopefully no other content creators are watching us and steal it, but like the idea is how much would you have to invest at a certain return rate starting at 0 to have $1 million by 65? And obviously $1 million at 65, like 65 years from now, $1 million is going to be worth $1 million, but it's still going to have the same number of commas. What it buys you, I can't control, but it's still going to have it's $1 million regardless. So, and a little spoiler alert, if you started as like, if you just had a kid and you wanted to put money in an account for them and they received a 10% rate of return, it's $6 a month every month from now till 65. And they would have $1 million in that. And like just little things like that. And I don't know if I'm going to do it with shorts or a big video and like kind of go over all the ages or whatever, but it's one of those things where I'm just like, if I did that for my kid, $6 a month every month until he turns 18. And then when he's 18, I'm going to say, hey, look, just $6 a month. Keep it going. When you're 65, you'll have at least $1 million based on a 10% rate of return. And I think the end of that was like 2,484 or it's some combination of 2s and 4s. I know it's 2,000 something. It might have been 2,848 or something. I don't know. That's all the amount of money that they would have put in that account to get it to $1 million. And like, that's going what you're talking about. Like that's literally less than $2,500, give or take, that you put in to turn into $1 million in 65 years, which is wild.
That's like 99.99999%
Yeah,
growth. That's
exactly.
crazy.
Yeah. So like like I said, I had that video idea a while ago, and it was like, the thing that's really cool is seeing that small amount. And then the thing that's really depressing is for the people that are saying, oh, I don't, it's not time for me to invest or whatever. I can't invest or I don't know anything about investing. The longer you wait, the jumps in what you need to add per month get ridiculous. Like
Massive.
I was getting depressed when I was looking at it for like a 56-year-old. And I'm like, oh yeah, that's cool. Yeah, you just have to add $8,316 a month for from now until 65, and you'll have $1 million. I'm like, who has that much extra money? Like, I don't. That'd be nice if we did. But like, so it's one of those things where it kind of does a twofold approach with that same data that I pulled is like how little you have to invest if you start early and how much you have to invest if you start late. And the end result is the same. It's just time. That's the only thing that's changing. So that's pretty wild. But yeah, kudos to you for doing everything that you do, especially with that, the personal finance. And I'm a big football fan too. So make sure you hey, second place doesn't matter. I don't care what anybody says. So no participation trophies. We don't do that.
Yeah, we've done very well on the football field. We've won 3 state championships in 5 years.
There you go. Yeah, make those kids nasty. We don't need no more soft stuff. But okay, so all this to say, my first question is, when did you specifically begin investing? And then what got you into the dividend side of investing specifically? Did you start with dividends or did you start with something else and wander your way on the dividend side?
So I started investing, on a much smaller scale. Now I contribute a whole lot more than I used to. But when I was in my early 20s and working my first jobs, we were young and dumb, and we thought 401k was something you run like in the Boston Marathon. Like we had no idea what any of that stuff was. And, I investing a little bit. I had a match at my first job, so I invested up to the match just to do it. I knew a 401k had something to do with retirement. I knew a Roth IRA had something to do with retirement, but really didn't know what it was. So I put a little bit of money into it. A couple of years later, when life happens and you start moving to bigger cities and you need more money, you stop contributing to your Roth IRA. And so I stopped doing it for a few years. And then starting in 2019, I really started to kick it into gear, investing, increasing my contributions in Roth IRAs, brokerages, 401ks, and have really, increased the amount of money that I put into retirement because I'm 36 years old. So my wealth multiplier is going down every year, pretty substantially. So I got to make sure I take advantage of it while I can.
Yeah. Yeah. So when you started, when you were in your 20s, was any of that, was that like all ETFs? Were you doing individual stocks? You don't even remember what you were doing, or how'd that work?
Just S&P 500 mutual funds that were inside my 401k.
Okay. Yeah. Well, yeah. And that's like 401k. It seems like most of the 401ks I see, the options are awful. Why is that a thing?
Well, most 401ks will offer you some variation of an S&P 500 index fund. I've seen very few that I've seen don't offer that. But you'll never go wrong with a Vanguard, a Fidelity, an iShares, any of those S&P 500 index funds. Like if you literally just invest 15 to 20% of your income in those for 40 years, you're going to be a multimillionaire at retirement. Mm-hmm. It cleans itself. Most people, and again, I didn't until I really took a deep dive and started getting on, YouTube and social media and learning more about listening to podcasts and learning more about, personal finance and investing and retirement. And, because you just don't know what you don't know
Mhm.
until you realize that you don't know it.
Yeah. Yep.
But yeah, just, I was investing in v.f.i.e for, 2016, 2017 times in there. And then I just quit for a year and then got back into it. And, I started maxing it out. Like now, it is a mission of mine to max out my Roth IRA every year, to
Mhm.
contribute my 401k up to the match and beyond, depending on where we are financially and things of that nature.
So do you, being a personal finance teacher, do you ever hit them with the paths that they could go on? Because I have a video that I talked about this with, where like if you plan on retiring, which everybody does, it really depends on when you plan on retiring. On the, like, to me, there's two paths, and obviously the first path is like writing a budget and getting out of bad debt and stuff like that. But then there, I think it was like step 4 or 5, the path really splits, and the path splitting is based on when you plan to retire. If you plan to retire at 65, 62, whatever, anything after 59 and a half, that's where you can really, go in and you can max out your, or you can max out your Roth, get your match in your 401k. Then you can start adding the rest of the money to the 401k. And if you have any extra money left over, congratulations. And also go open a brokerage account or something like that.
Mm-hmm.
Again, not financial advice, whatever. But then my path is I want to retire at 50. I'm 29. So like my path's a little different because I don't want to tie up all my money in retirement accounts that I can't access for 9.5 years when I plan to retire at 50. So is that like something that you consider for yourself? Do you plan on retiring before 59 and a half or 60? And then do you teach that part of the stuff to the kids as well? Or how's that work?
No, in June of the year that I turned 60, I'm going to retire from teaching. I've already
Okay.
kind of planned that out. But like you said, if you do retire before age 59 and a half, like you're going to need a brokerage account to give you a bridge until you're able to withdraw from those retirement accounts penalty free.
Yeah. Yeah. Okay. And then, so do you do any, I know you said you did S&P 500. So two questions on that. Did you, when you stopped investing and you said around 2017 and then picked back up, did you get to see any of the growth in there? And like, did that because I know when you said you first started it, it was just kind of like, I know I'm supposed to do this. I don't really know anything more than that. So were
Right.
you like surprised when you look back at your account and were like, hey, this thing, like, I remember last time I looked at this, it was only this and now it's this. So like, was that kind of like a positive affirmation kind of thing?
Yeah, for sure. I mean, it definitely went up in value. You start thinking like, holy crap, like that's went up, $4,000 since the last time I looked at it, and I literally did nothing for it. It includes the dividends that
Yep.
were paid from the mutual funds and the index funds, and but the overall growth of the market. There were some years in there where the market was up, 12, 15, 18%, and definitely seeing that growth makes you, the light bulb kind of goes
Mhm.
off in your brain, and you're like, holy crap, this is kind of cool. It goes up in value, and I do absolutely nothing for it. Um, so yeah, I mean it's cool to see, and then once you get up to the big numbers, when you have several $100,000 in saving or retirement accounts and investment accounts, you really see those numbers start to jump. Like the other day, the market was up almost 1%, and my investment account went up $3,000 in one day. And I started thinking back, like when I got my first job, like
Yeah.
I made $982 a month,
Yeah.
and now my investment account went up almost $3,000 in one day.
Yeah. Yeah, and that's where I think it was Charlie Munger that had the quote of like your first $100,000 is the hardest. Really, he could have put any number in there. Your first anything is the hardest. Like literally, your first step when you learn to walk, your first day at school, your first day on the job, your first $100 in dividends. Everything the first is always the hardest, and then everything after that in the same increment is exponentially easier because you have whatever it is, whether it's experience or time or the money working for you. So it is really cool, and then on the flip side of that, you also get to experience, when the market's down 3%, you get to,
Right.
lose 10 grand in a day. And you're like, son of a, like, I don't even gamble. I didn't have any fun to lose that money. So,
Right.
that's pretty cool. So do you, strictly just do ETFs and stuff now, or do you dabble in some individual dividend stocks, or how's that work?
So I've got a brokerage account. I've got about 16,000 in it right now, and I've got some REITs and some dividend paying stocks, and I've got some like dividend aristocrats. Like I've got 15 or 20 shares of Coca-Cola
Mhm.
and some other companies like that. But I've also got some stupid stocks where I listen to influencers on social media
Yeah.
and they recommend stocks, and
Yep.
then I buy them, and then now they're down 88%,
Yeah.
and I'm just going to hold on to them and see what it does. A
Yeah.
lot of people go out and blow a couple $100 in Vegas or in a casino or something. I'm just going to look at it as I blew a couple $100 on XYZ stock, and now it's down. So we're going to watch it for the next 10 years and see what it does.
Yeah. Hey, I mean, good news is, I mean, you're going to lose money whether you're at the casino or doing those stocks. Good news is you don't have to get secondhand smoke. You losing money in your stock portfolio. So that's always the bright side there, I guess. So yeah, that's interesting. So did you do you, just out of curiosity, do you ever talk to the kids about dividend stocks? You don't really go that deep.
We don't necessarily talk about dividend stocks. We do talk about ways that stocks and ETFs and mutual funds and all these different types of financial products you can buy. We do talk about ways that you can make money through those things. You can make it through appreciation when you buy it at a lower price and it goes up in value, but you can also make money from dividends. Most dividends are paid quarterly, and we cover all that in our class.
That's super cool. Yeah, I'm super excited to hear about that because that, like I said, that's what we need. Is like there's so many, and the worst. I don't even know if it's the worst part, but one of the bad parts is just like it's a lot of parents are financially ignorant, and that rubs off on their kids because again, you don't know what you don't know. And then that's where the saying "ignorance is bliss" comes from because at the end of the day, you're just like, oh yeah, there's that kind, investing or whatever. I don't know about that. But as soon as you learn one thing about investing, you realize there's so much more that you had no idea. Oh, there's different kinds. Oh, there's different ways to mitigate loss and risk tolerance and timelines. You're just like, I don't know what, like, I didn't know all these things. So it gets more overwhelming the more you learn, and it never ends either. Like you never know it all. So
yeah, there's always a rabbit hole to go down in the personal finance realm.
Yeah, it's good and dangerous. So, okay, so for you, and you said you have this in your brokerage account, so maybe you're gonna just talk about the brokerage account, but like, do you have any like biggest dividend related mistakes that you've made? I mean, and it sounds like you kind of already spoke on those. And more importantly than the mistake is, what lesson did you learn from making that mistake?
I mean, not necessarily like a dividend mistake. I mean, I did throw a decent little chunk of change in some like speculative companies that people, online YouTube influencers have recommended, and it's turned out to be a complete disaster. But I wouldn't say I've necessarily made like a dividend. Like I haven't bought anything that's got well, actually, I take that back. I have bought like ABR and some other things. ABR is a REIT, I believe,
Yeah.
and it pays, at the time I bought it, it was paying like a 12 or 16% dividend. And then it's went down. I think it's down like 60 or 70% in value. Still paying a pretty sweet dividend, but it's down. Overall, it's down like a couple $100, and it continue to pay. I'm pretty sure it pays a monthly dividend. That's one of the mistakes I've made. Just following people on Twitter and following YouTube. People who say this. This is going to be this, and it pays this, and just chalking it up to being young and dumb and not knowing anything about what I was buying. Nowadays, I don't buy anything that I don't feel like I have a complete understanding in.
Yeah, well, that's what's really important is like the lesson that you learned is that like no matter how, how charismatic the person, even me, like when I have my top 5 series that I talk about on Fridays, it's not oh, Troy talked about this stock, it's got to be the best thing of all time. Like that's not even the goal of the series. The goal of the series is quite literally, hey, here's 5 stocks that I really like. Here's why I like these stocks. Go do your own stuff and see if you like these stocks as well. And if you do, like and what you're talking about is so important because at the end of the day, the stocks that you have no worry about selling. If the S&P, like, and I don't want to use the S&P, but if some stock that you really like goes down 5%, you're never, oh, here we go again. Like I got to sell this stock, or when's it time to sell? You're like, oh, this is a good buying opportunity. But if it's a stock that you were convinced to buy and you don't really understand it, it goes down 5%. You're like, should I get out? Like the mindset of that's completely different based off of like, did you find or convince yourself about this stock, or were you given this stock or convinced otherwise that you should have bought it?
I mean, the YouTube channel I watched was Stockmo at the time. I used to watch it religiously, and
is that still
the
up?
guy
I haven't
had
even
some
heard
good
of that.
insight. Yeah, Stockmo. He's like, I mean, he's got several 100,000 subscribers. And the guy would throw out stuff like, out there. The channels went downhill a lot recently, but it used to be, high quality material. And, I would follow it religiously. I'd watch it every day. He'd put out two episodes every single day, and I'd watch it, and he'd make recommendations, and bought some, and, learned within a few months that yeah, this is not for me. I'm just going to buy the S&P 500 and roll with it.
Yeah. I mean, that is, if I didn't have a YouTube channel where I have to like entertain people and, provide portfolio updates and stuff, that's what I would do. I mean, so much so that my Roth IRA is just that. Like it's just ETFs. I have like QQQM, the S&P 500. There's actually one that I found, and maybe this ends up being like content or not content, but literature for your classes, or maybe it's just food for thought for you. But one of my favorites recently is UPRO. It's a 3 times leveraged S&P 500 fund. And like I understand the risk with it. Like the risk is obviously the S&P 500 goes down 20% and I lose 60%. Like I get that. But at the end of the day, like there's never, I think it's a 20 or 30 year period. There's never been a 20 or 30 year period where the S&P 500 didn't return positive results. So I plan to hold it for a long time. And if I have at least 29 years until I plan to retire. Now this is in my Roth IRA, so I have even more time. Like I'm just gonna like let it do its thing. It's already one of my top performing positions, and I just added it this year. So yeah, UPRO, it's just leveraged S&P 500. Now, granted, 40% of my Roth IRA is VOO. Like it's just put it all in there, and then the other 6 positions make up 10% each, and they're all ETFs except for Tesla. So it's just like that's my hey, like let this grow tax free, let it do its thing kind of thing. And then I have, the taxable brokerage account similar to you, where it's more not necessarily fun. Like that's the one I plan to retire off of, but like that's the individual stocks that I track on the channel and stuff like that. So I do like, okay, so next question. I mean, and this one's, you kind of answered this already too. So how would you say that your investing style has changed from when you first began investing to where it is now? Like, what do you do different? What do you do the same?
I mean, I was a lot dumber when I first started investing, to be honest. And I'd do research, and I'd go on like Yahoo Finance and Seeking Alpha and read all these articles and try to find some single stocks and things of that nature. I'm actually contemplating doing it now with some uranium stock companies, and just researching. But it's all fun money. It'll go in my brokerage if it's a couple $100 and it goes to zero. Who cares? It doesn't change my life. But I mean, yeah, I'd say 98, 99% of what I buy nowadays are mutual funds or index funds, S&P 500 or QQQ that follows the NASDAQ, or, something of that nature. One of my favorites is the Vanguard Growth Fund, VUG. I love VUG. It's up, year to date, I think it's up over 10%. And, it was up 30 something percent last year. And, it's one of the growth stocks that I like to go to. I keep in my Roth IRA, and, also I buy growth stocks in my 401k as well.
Okay, so two questions for you, because like I don't know that I've asked these on like other, because I've interviewed other people that are like bigger into ETFs and stuff. So first question is, as far as diversification is concerned, do you ever do you look at like the fund overlap websites to make sure that you're not buying like this ETF and this ETF that are too similar? Like they basically cover 98% of the same stuff. And then two is, how do you? I personally think mutual funds are just like higher fee versions of ETFs. So like, do you still buy mutual funds instead of ETFs? Like how do you decide which one to buy?
Well, technically in my 401k, I buy an S&P 500 mutual fund,
Okay.
because you can't buy ETFs, or you can't buy, anything that you buy inside a 401k in most companies. I know in my company is technically a mutual fund.
Yeah.
It's VFIAX. But the fee is like 0.02%. Like it's almost free. But I mean, I do buy, for a long time, I did buy the Growth Fund of America through the Capital Group. And it in most years since I've been buying it, it has outperformed the S&P 500. Like last year, it outperformed the S&P by almost 3%.
Wow.
So that was worth paying the, 0.5% expense ratio and fee for that fund. A couple of years it underperformed, but, I'm just going to hold on to it and let it ride. If it, if it keeps up with the S&P or barely underperforms it or overperforms it, like, it's not a huge deal for me. I know people make a big deal about mutual funds and the expense ratios and the fees and things of that nature, but I'm going to roll with it. I bought it. I was a big time Dave Ramsey follower, and the Ramsey SmartVestor Pro recommended these through, the American Funds Company. And, it's one of the biggest fund providers in the country, right behind Vanguard and Fidelity. And, decided to go with it. People ask, well, why don't you sell it? Why don't you move it? It's just not worried about it.
Yeah. Yeah. I mean, to me, the bigger, it's really the opportunity cost. Like if there's no other, like you're talking about in Roth and not Roth in 401ks, it like you're going to track that the only option is a mutual fund. That's okay. To me, it's just like, okay, if I'm opening my taxable brokerage account and I can buy a ETF that tracks the S&P 500 or a mutual fund, I'm like, okay, typically ETFs do have the lower, and like you're saying, you're not even talking whole percentages at that point. But
Right.
if you end up planning to grow that to a couple $100,000 or $1 million position, a couple halves a percent or something ends up mattering. Especially when the alternative is less money. Like I would rather, like, if you're going to make the same exact amount of money for both of them and one has a higher fee than the other, I'm like, why would you not? But like, I agree with what you're saying. And then as far as like the overlap, do you ever get on websites like that to make sure like, VUG and VOO don't have too much overlap, or how do you do that?
Well, yeah, I mean, they have some overlap, but VUG is going to be more centered around growth
Mm-hmm.
companies. It's going to have far less value companies. So VUG, I mean, VUG is going to outperform over the long run. It's expected to outperform the S&P 500 just because it's centered around growth. Now, in times of bear markets, it's going to be hit a lot harder.
Mm-hmm.
But again, that's the risk profile that you take when you're more focused on growth stocks.
So is I've heard of I know I don't have VUG, but I know I've heard of it before. Is that more, because obviously the S&P 500 is the 500 largest cap. So is VUG, does that hit more like mid cap, small caps because it is more growth focused, or is it still large caps?
Yeah, it's more. I mean, it's a lot of large cap. It does have a few mid caps, but it is very growth oriented. It's growth focused. Like I doubt they're going to have like Johnson and Johnson or
Yeah.
Coca Cola or some of these other like value stocks that are going to not take huge nosedives. Are going to be consistent dividend payers, but you're not going to see 10, 12, 15, 20% growth in those stocks just because they're value type companies.
Yeah. Okay. Yeah. I didn't know if it was, because I mean, you would, like, in theory, small cap companies have more room to grow. Because like you said, like Apple's not gonna double tomorrow. Like Apple's too big to double tomorrow, but a small cap company can triple in 3 weeks. Like it's just one of the, if they have a good earnings report, like who knows? So yeah, that's interesting. So like I said, I've heard of VUG before. I just didn't know if it was like, okay, they loosen the filters a little bit because they do have to, like you said, capture more of the growth companies instead of your Coca-Colas, your Procters and Gambles, Johnson and Johnson, 3M, stuff like that. More like kind of get rid of the dividend kings. Not that
Right.
all dividend kings can't grow, but a lot of them are already fully mature companies and they're kind of, what they are kind of thing. So
Right.
okay, so next question for you is like, do you have any short-term and long-term goals with your portfolio? Like, I know you have your taxable account that's kind of, like you said, for fun money, and you don't really care if you make it or break it kind of thing. And then you have your retirement accounts that are set up in ETFs and stuff. So do you get any like short-term goals that you hope to achieve in 2024, say, or like is everything just focused on, when you turn 60 and you're done?
Yeah, I mean, short-term goals in a sense of like I've got my goals that I want to hit every year. Like my goal is to max out a Roth IRA for my wife and I every single year. And my goal is to both of us invest into our four. Well, technically, we have 403bs, which is same exact thing as a 401k, but for a nonprofit company. We both work for nonprofit schools. Um, so both of us are our number one priority is to max out the Roth IRA, invest in our 403bs up until the match. We both get matches at our place of employment to fully fund both of our not high yield health savings account
Mhm.
HSAs. And then after that, if we have any other allocation that we want to put into an investment account, we'll increase our 403b contributions, and then I put $100 to $200 in my brokerage account every month just because I have a few bucks left over and I see some stocks that I like or some companies I want to dabble in and just go do it.
Yeah. Yeah, that's really smart with like the whole plan and stuff like that, because it's like I said, it's the so often everybody thinks that investing is like a one size fits all kind of thing, and there's so much, there's enough nuance to it that it scares people, but there's enough nuance that you can kind of, again, it's called personal finance for a reason. Like you can kind of customize it and do it how you see fit. So that's really cool the way you guys do it. I do have a match at my job. But we don't have HSAs and stuff like that, which is really, because I never go to the doctor, so it's really annoying that I have to pay all this freaking high health insurance that I don't even use. So one of my previous jobs did have an HSA. I maxed that out, and then I don't know. Did you off topic? One topic. Did you ever hear the story of the guy that became a millionaire out of his HSA account?
I didn't. I mean, I'm assuming he invested it in VOO or something and never used it.
Well, so I think if my memory's right, he ended up investing it in like PayPal like years and years and years ago. And
Yeah.
he grew it. And so he was like he did that, he grew it, but when he because like getting money out of an HSA for things that aren't health related is difficult because that's the point of the account. So what he did is he put all his money, because you can invest HSAs, which a lot of people don't realize. They think it's all just a piggy bank for my health money, but you can invest it. So he was investing in like PayPal, and obviously he got lucky with PayPal, or maybe he was just fortunate or whatever. But he did that, and anything that he used as far as like health wise, whether he went to the chiropractor, the dentist, the doctor, whatever it was, he didn't take it out of the HSA. He kept all the receipts and scanned them. And then when he retired, he was able to withdraw and reimburse himself tax free from his HSA account that grew from PayPal. And he just let it grow for like 40 years. And I was like, that dude, that's the type of guy that gets rules and regulations written against him. Like, hey, like there's got to be something changed about this because the government, Uncle Sam's like, he got how much tax free? Like, what's going on there? So yeah, I heard that. I heard that a couple of years ago, and I was like, that guy's a genius.
Yeah, I heard. I forgot who the investor was. There was somebody who did the same exact thing with PayPal, but inside a Roth IRA, and they got in like early when they got in as like not an angel investor, but like one of the pre-market investors when you can invest in PayPal before the IPO, and they bought it at a dirt cheap price, and they bought it inside a Roth IRA, and it went up like 10, 15, 20,000% or something, or
Yeah,
40,000%, and they had. I mean, it was crazy. It was like a $1 billion Roth IRA or something out of one allocation or
all tax
something like
free.
that. I forgot when it was. It was about a year or two ago.
Yeah, yeah. So I mean, the to me, one of the big tells, like the government knows, like, hey, this is kind of like a really good opportunity, is when they put limits on it.
Oh, for sure.
Like 401ks, limits, Roth IRAs, limits, HSAs, limits, and like other things, brokerage accounts aren't limited because why? Because most people suck at them. Like they're just like, okay,
And,
one, you're already paying taxes on the money you put in. Two, you pay taxes on the money you take out. So it's kind of like whatever, yeah, grow it to whatever. We'll get our money anyway. But the ones that they have the shells on them, they're like, there's a reason behind that because if you do them right, you can really you can have a lot of money.
and
Um,
that's exactly what I told my class. I said, anytime the federal government wants to limit on how much you can use a financial product, it must be pretty freaking awesome.
Yeah, figure out all the pros and cons of that financial product. Like that's the one you need to focus on because yeah, I that's there's something to that. Okay, so do you? I know again you do a lot of ETFs and mutual funds, but do you have any stocks, like maybe an individual stock that you bought that you regret? Not necessarily regret buying, but do you have any stocks that you bought that you are excited that you bought, like a buying brag? Or do you have any stocks that you sold that you really wish you wouldn't because it was like a good company and you just, didn't have the courage or whatever to hang on, the patience more or less to hang on to that stock?
Oh, one that I bought. Yeah, I'm trying to think. I'm just kind of scrolling through my portfolio here real quick. I don't know. One that I bought that I made a lot of money. I mean, Palantir. I bought
Hmm.
Palantir when it was dirt cheap,
Is this
and that's went
pre-COVID?
up a lot. Do what?
Did you buy it pre-COVID?
Yeah, pre-COVID and then right as COVID was happening. I
Yeah.
think my cost basis is like $3 or $4,
Nice.
$4, $5, and now I think it's up to 20, 24, 18 right now.
Wow.
So, I mean, yeah, I've made a chunk of change on Palantir. One of the ones that I bought that I was very disappointed again, Stockmo recommended it, went on and did it, or no, he didn't recommend. Somebody on Twitter recommended it, and I did some research. I thought it was cool, and it turned out to be a disaster. Was a company called AI. Or the ticker symbol AI. It's like C3P something something
Oh
something. It's
yeah,
supposed
yeah.
to be
I
like,
know. C3PAI or something like that. Yeah, yeah. I know what
yeah,
you're
it's
talking
supposed
about.
to be like a big time artificial intelligence company getting all these contracts, and the stock went to crap. And I haven't looked at it in years. I wound up selling it at a loss. That's one of the. I probably sold 5 stocks in my life, but that was one of them. And I just, I did my research and learned about tax loss harvesting and sold it at the beginning of 2023 to get that I believe it's $3,000 a year that you
Hmm.
can get in tax loss harvesting.
Yep.
So just trying to take advantage that and roll with it. Chalk it up as stupid tax.
Yeah, yeah. So do you have any do you have any rules towards like when you talk about Palantir and you made all the money off of Palantir, do you ever trim a position to take gains? Do you plan to hold it forever? How do you handle that?
I don't. I've had I've held it for longer than a year, so I'm eligible for the short term capital gains tax. But I got no interest in selling it. Like if it goes to zero, I don't even know how much I got in there. But Man, if it goes down 50%, I'm just going to hold on to it because it's a company that is constantly getting government contracts for artificial intelligence type work and the field that they're in. And the financial advisor, one of my players' dads is actually a major financial advisor, financial planner, and him and I have had discussions about Palantir, and he's all for it. Like, he loves it, so I'm just going to hold on to it.
When I first heard you say Palantir, every time I hear somebody say that, the company that pops in my head is Peloton, and I don't know why I always get those two mixed up. And I was like, when you were just talking about it, I was like, what kind of artificial intelligence do bikes have? Like, they're just stationary bikes. I was like, what's going on there? I was like, wait, that's a completely different thing. What am I talking about? So
Right.
yeah, so not Peloton, not that one, not the
Right.
bikes to nowhere, not those. Okay. Yeah, one of my biggest it was like you said about like learning and figuring it out kind of thing was CDW. I bought that when I first started, and it was one of those companies that I identified with however I identified all the other crappy companies I bought, and that one would just ended up being really good, and I sold it. Now I look at it, I'm like, man, if I would have freaking even just kept that, like, of course there was 15 other stocks that I bought that sucked, but that one was one I'm like, man, if I would, like, that one still fits all my metrics that I like today and stuff like that. So we all have them: buying regrets, selling regrets, buying brags, stuff like that. So okay, so with your individual account that you do get dividends from, do you track the money that comes in from that as far as like the passive income? Do you put that on a spreadsheet to watch it grow? Do you do any stuff like that?
I do. I'm a super nerd. Yeah,
Okay.
I track dividends every 2 weeks or something. I'll sit down and I'll go back and look through my accounts and keep up with how many dividends I've received.
So, well, I'm glad that you said that because I was going to be lonely if you didn't, because I definitely do that too. So, do you like when we talked earlier in the interview about like delayed gratification, do you ever, are there any milestones or achievements that you hit with that dividend portfolio and the tracking that like really keeps you going? Because at the end of the day, when you're a dividend investor, even an investor in general, it's not like what Instagram makes it seem like. Oh, I just bought this stock; it's a 10 bagger tomorrow. Like that's not how it works. So like, do those milestones and achievements like keep you motivated and like keep you on the goal towards the bigger picture?
Yeah, I mean, absolutely. Like, I mean, the dividends, the total dividends are jumping up every single year. I mean, it's almost doubling from year to year.
Mhm.
Looking back at it, I've actually got my spreadsheet open here. Back in 2013, when I first started investing, that was my second year out of working full time and investing. I made $27.18
Mhm.
in dividends. And then fast forward to 2023, I made $5,015.59 in
Heck yeah.
dividends. So it's continued to jump, and it was a slow growth. It went from 104, 120, 130. Those were those years when I didn't contribute a whole lot. And then fast forward to 2018, it goes up to 286, 510, 1032, 2902, 3634, and then in 2023 it was $5,015 in dividends.
Do you already have your projection of when you're going to pass last year's dividend total?
I don't know when I'm going to pass it, but I'm hoping my estimated, like my gross, rough estimate is it's going to be about $6,500 this year
That's
in
super cool.
dividends.
Yeah, I have all those. I think most dividend investors have all those numbers. Like the patty, I think is the number you're talking about, where it's like the projected annual dividend income, like forecasted
Right.
out 12 months kind of thing. Which is like that's a cool number because like anytime you buy and you update your spreadsheet, you can always see that number go up. But then like going back to what you're talking about with teaching the kids about like the psychology of it is like that's how people also get stuck with yield traps and stuff because they're like, oh, cool, I like watching this number go up. How can I make this number go up even quicker? And then they just focus on the income produced by their stocks and they're not aware. Like I always say, it's the dividend sleight of hand. When a company pays you $75 in your left hand but loses you $100 in value in your right hand, like you're a net negative 25. But everybody, oh, don't worry about the right hand. Look at the left hand. Look at that $75. I'm like, yeah, but like you lost money. Like I don't get it.
Yeah, I definitely fell into that trap, a couple years ago. Because, like most people, I mean, I think I've seen data where like more people invested in the stock market and started trading or started investing around 2020 because everybody was at home. They were in front of their phones and computers all the time. The information was out there. Stocks were on sale. I mean, stocks were 35, 40% off, in relation to the S&P 500. and more people started investing in the year following COVID than they did at any other point in the history of the stock market.
Well, it's the accessibility of it. Like now you can buy it on your phone. Your phone's always in your pocket. Like you can do Robinhood or whatever. And even like regular brokerages or, the more typical brokerages, they have it like they have apps on their phone and stuff like that. So I think it's that. And the fact, now this is, I've told this story on the series before, but I know so many people personally that they still don't understand delayed gratification. And when they started in 2020, anything you bought went up, everything went up.
Right.
So like, it was like, oh, okay, I bought this. Oh, next week it's up 40%. Like this investing thing's easy. Like no wonder, no wonder Warren Buffett invests. Like this stuff's, it's everybody could do that. And then it was 2022 happened. And everything went down. I think the S&P was down like 19.45% or something like that. And then that's where they say, oh, investing's a scam, whatever. And I'm like, no, like first of all, the market's not always up and to the right. It's up, down, everything in between. And over long periods of time, it's up and to the right. And you also have to have good companies. Like you were just buying stuff because you saw it. Like it was on that's how I started. It was on the top mover from the previous day. I'm going to buy it again because of course it's going to go up tomorrow. During COVID times, that's how it worked. But during every other time of the market, that's not how it works. So I know a lot of people that got so put off by that where it's just like, okay, like everything I buy is going to, turn to gold kind of thing. And I was just like, that's not what we're here for. Like if it was that easy, there would be no poverty.
Yeah, you got to have like a financial mutant. I call it a financial mutant mindset when it comes to stuff like that. In reality, and we've talked about this in my class when it talks about managing risk and things of that nature. But when the stock market goes down, when we're in a bear market, people stop buying. Like the stock market is literally the only place when great companies go on sale that are 20, 30, 40% off, people are scared to invest. If Target or freaking Academy had a 40% off sale, the line would be wrapped around the store 10 times.
Yep.
But the stock market is the only place where people are scared to invest.
Yep.
I hit some home runs during COVID when I had saved, I was saving up to buy my first home around that time. I'd paid off all my debt. And I had about I think it was about $25,000 or $27,000 saved up for a future home down payment. And the stock market fell 40% in March of 2020. And I started thinking and listening to some podcasts, and I'm like, I may never get another buying opportunity like this again in my life. So I maxed out the remainder of my 2019 allocation. I think I had about $2,000 or $3,000 to finish that up. I maxed out my entire 2020 allocation in my Roth IRA, and I increased my 401k contribution to 52%.
Wow.
So, I mean, I killed it. I put roughly $20,000 in March, April, and May in the stock market at a 30 to 40% discount, depending on when I bought.
Yeah.
And that's been a huge step in catapulting in my net worth and my investment accounts and things like that, jumping in value. I thought, man, I can always save up more money and go buy a house later. So it all worked out.
Did you end up getting a house with a good interest rate, or did you miss out?
I did. I bought a house in March of 2021 at a 2.49% interest rate.
Oh, you beat me. I'm at 2.75. I like hearing all the interest rates that people are, because the wife and I are in the process of like saving money for the down payment on the next house that we're going to build. And it's like right now interest rates are really high, which we're not in the market to buy right now anyway, because we don't have the money saved. But everybody tells me I need to rent this house. I got 2.75% interest. I'm honestly afraid of tenants, just because like evictions suck and it's a long process, and I'm not handy. So if somebody breaks something at the house, I got to call somebody. That costs money and stuff like that. So yeah, I'm always excited to hear people's super low interest rates, and then we'll see what happens 10, 20 years from now if people are selling those houses, because I mean a lot of people don't want to lose that interest rate. So we'll see.
For sure. The only kicker I can see selling one if it goes up, because you get $500,000 worth of tax-free growth or tax-free appreciation from your home if you sell it if you're married, and that's the only way I can see people selling is they got $500,000 worth of tax-free equity in that house that they'll sell, and then they'll just put all that down on another house.
Yeah, I was gonna say, does that matter? Because I know there's some rule, because I was looking this up. There's some rule about like the capital gains that you make from properties. I wasn't even aware of a limit, but the capital gains you make from properties, as long as it's spent on another
piece of land or property or a house or whatever within 12 months, you don't have to pay any taxes on that? Is that how that works?
Yeah, it's called a 1031 exchange.
Okay.
But no, how it works for your primary residence. If you're single and you own a primary residence, you have $250,000 worth of capital gains that are completely tax free if you sell your primary. Now, if I sell my primary and I have a net gain of I have a capital gains of $1 million, I'm going to have to pay taxes on $750,000 worth of profit. But if you're married, it doubles. So if you're married, you sell your primary residence and you have $500,000 in capital gains, you don't pay any taxes on that capital gain.
Now, is that like you could just sell the house and then not use it for anything? Like,
Correct.
or do you have to use that by a certain time to not pay that?
That's a great question. I'm not 100% sure on that answer, but as far as I haven't heard of any, type specialty rules with that. It's tax-free money.
Huh.
Say for example that, we had a job and it moved us to, DC or New York, and we were only planning on being there for a year. Like, we're not going to buy a house, so we would just pocket that money and hold on to it. But that's the first time I've heard it. It could be, I'm not going to say it's not, but it could be a special rule where you have to buy another home within 12 months. I don't know.
Yeah. Yeah, that's because I was doing that as well. Because I was thinking, I was like, man, like, what if we just, even if we sold this and just like put it in land that you did, like, because I think that's the catch is that you sell your house, take the gains, you put it towards land. So there's not technically a house there that you're paying a mortgage or anything on, but you're also not paying any taxes on the gains, and you have land that you can build your next house on or whatever. But also, if I was, spending that much, I don't want that much land. So that's a lot of land. And then out of curiosity, do you know, say you are single filer, and you make that 250, and say you make 300, you're going to pay taxes on the 50,000 extra. Is that go ahead?
From what I've read, I mean, I've never sold a house. I've only bought a house. But from what my understanding is, then you would pay taxes on that additional $50,000 in gains. And I'm not sure if it's long-term capital gains or if it's at your tax rate.
Yeah, that's what I was going to wonder. I mean, if you held it for over a year, I mean, knowing the government, you're probably paying your income tax rate because they got to get their extra money. But technically, it's an investment. I sold it, made more money, and I've held it for over a year. I should pay long-term capital gains.
That would be my argument for sure.
Yeah, but the government doesn't care about us, so they don't care about our arguments. But yeah, that's interesting. So I like that. Like I said, it's it's something that I'm gonna be crossing in, I don't know, 2 years or so. So we'll figure it out. But I'll keep you posted. Okay. So next question is, I mean, you already answered this. Okay, so I'm going to spin this question for you because of the answer you already gave. So the original question is, how and when will you know when enough is enough? So pretend you get a really bad batch of students when you're 55 years old. So it's before your age of 60 that you said you're going to retire. If you get a really bad batch of kids, but your portfolio is already worth $3.5 million, is that enough? Is that like enough for you, or are you going to stick it out for the 5 more years, or how do you think you're going to handle that?
So if for some reason I ever got to the point where I'm just like, I can't teach anymore, which I don't think I teach PE. Like, I love my job.
Yeah.
I mean, I couldn't imagine being a classroom teacher and teaching like science or math. Like, I just couldn't imagine. But I teach PE.
In 20 years, everybody's going to be walking around with Apple Vision Pros. They're not going to care about your PE.
Right. So. Yeah. PE is going to be all digital by
then.
If in the event that I ever did get to that point and I wanted to get out of teaching, I'm a hustler, man. I grew up on a farm. Like, I'll find a way to make money and make a living. I'd go umpire full-time. Like, I've always wanted to be like a full-time high school baseball umpire, full-time high school official, go do football and basketball and baseball and things of that nature. If I ever wanted to pull out, I'd do something like that, or I would grow my financial coaching practice a little bit more and make that more of a full-time gig, or give private baseball lessons or coach select baseball. Like, I've got, several of my coworkers or my assistant coaches, they're full-time baseball guys. That's all they do is coach select ball, give lessons, coach high school or middle school baseball, and they just make a living out of it. I would, transition to something like that. But I'm in a great spot and a great school and a great community. My administration, my kids are great. My players are great. The families are awesome. Like, I'm just in a great spot of where I work at. People ask me all the time, are you thinking about, finding a better job or a bigger school? And no, I love where I'm at. the people are great. The coworkers are awesome. Like it's a great spot to be in. I joke, jokingly, but I'm kind of dead serious. I tell people like the place I'm at is the kind of place you stay at for 25 years.
Yeah. I mean, that's good. That's what everybody's goal is to find, that role that they don't ever, like, you don't even know what the interface of Indeed looks like because you don't ever need to, like, you don't even need to know,
Right.
like, you don't even need to look. So, that's super cool. And it's, I mean, for the purpose of the question, it's more, that is kind of an acceptable answer because it's like, okay, how will you know when enough is enough? Well, enough for you is when you no longer enjoying doing what you're doing. And for a lot of people, that's now. So like they are answering the question of like, how much do I need to get to in order to not do this thing I don't want to do anymore? And for you, it's how long can I do this thing I enjoy doing until I don't enjoy it anymore? Like that,
Right.
That's kind of the answer. Like the money will take care of itself. And even it sounds like when you retire, you might want to just try to do other things regardless of the money, just because you enjoy doing them anyway.
Man, I love fishing and playing golf, but I don't think I can do it 6 or 7 days a week. Like
Yeah.
I'm going to be out doing something. I'm going to be that 70-year-old umpire that I get so frustrated with now. That's probably going to be me in 35 years, 40 years out there. Can barely move, but he's out there because he loves the game and he wants to be a part of it. And I'm sure that'll be me when I eventually hang up the whistle and the clipboard.
Yeah. I mean, if you're like the home plate umpire, you don't got to move too much, right?
That's true. Yeah.
You got to get in that position. But I mean, some of them are really down there and then some of them are standing up kind of high. So just be the vertical one. You don't have to.
Yeah, and I'm 6'6" too. I don't know if you can see it from this from the video, but I'm 6'6", 260, so I'm a big dude.
Yeah, yeah. Hey, maybe you won't be frail then, because you don't want to be like a little frail old guy doing the home plate because they'll slide into you and break a hip or something. That won't be good.
Right.
So, okay, so when you select your individual stocks in your brokerage account, do you have any individual criteria that you use to, like, some people really dive deep into balance sheets. Some people like me, I have different kinds of metrics that aren't necessarily balance sheet focused, but the balance sheet leads to the metrics that I look at per se. So like, do you have any specific metrics you use when you're looking for stuff?
I really don't. I'm big on the financial Twitter realm. I have lots of people who I, just network and talk to and stuff like that, and they make recommendations, and then I'll do my research and look at the earnings reports. And I like the Yahoo Finance analysis where they'll show you like what all these analysts and things, how they feel about stocks and what they think. But I mean, that's probably the extent of my research. Again, 99% of what I buy are index funds or mutual funds that'll, mimic the NASDAQ or look for growth stocks or things of that nature, ETFs that do growth. But as far as like actual, bullet points that it has to check for me to buy it, I don't really do that. I like value companies. I like dividend aristocrats that I'll buy individually, things that I know are going to pay a dividend. That's where I get the majority of my dividends from, or my brokerage account. But
do you know what the CCC list is?
What is that?
That's the champions, challengers, and contenders.
I don't. Never heard of it.
So I used to use when I first started dividend investing, I used to use the Kings and Aristocrats. That's at least 25 years of dividend growth or whatever.
Mm-hmm.
The CCC list is basically the same thing, except the contenders is any dividend company that's paid and grown for at least between 5 and 9 years. The challengers are 10 to 24 years, and then the champions are 25 and more. So they will, like, the 25 and more will have basically all of your aristocrats and your kings on them. But then the other ones, like, there's other great companies that aren't on the aristocrats and kings list, like your Apples, your Microsoft, your Visas, stuff like that hasn't quite done it for 25 years, but they're still phenomenal companies. So there's actually a website, I've talked about it before, but it's portfolio, like, -, whatever you call that, insights. And it's a free site you go to. You can go to every Friday. They provide like an algorithm generated like document that's updated on Excel, and you can download it for free. I don't even sign into this website. So like there's no account, there's no signups or anything. And you download this and it has all these lists and it's updated weekly. So if somebody falls off, if somebody comes on, or if they move from one list to the other, it's just automatically updated. So after this, I can show you that website. I'll share my screen with you and show you that. But it's just another really great place because the Kings and Aristocrats, it's not every day that a company is going on and off the Kings and Aristocrats list, because like it takes 25 years to get there, so it's a long time. So you're just like, to me, I was just missing, because I was like, man, everybody always talks about Apple and Microsoft and some of these other great companies. Well, they haven't been doing it long enough to be on this list, but they're great companies. So like, am I gonna wait 10 more years until Apple's been paying it long enough to be on this list, or do I want to get some of that growth before they hit the list? That kind of thing. So
Oh, for sure. Yeah, that's awesome. I'm definitely gonna check it out.
yeah, so I'll share that with you. Like I said, it's portfolio insights.com, and it's free. And like I said, I'll show you after this. So, so going back to what you were saying about like not having criteria, I'm assuming if ETFs and mutual funds didn't exist tomorrow, like on Monday, we wake up and government got rid of them. There's no more ETFs and mutual funds. I'm assuming at that point you would kind of develop like a more solid strategy as far as like, okay, I need these stocks to meet these things. I need to have a dividend streak of a certain amount of years, or I need, like when you say you look at the profits and the revenues and the actual cash flow sheets and stuff like that, like you would have a certain number or percentage year over year growth that these need to hit or something like that. Like if you were more focused on that, but because you said, this is 1% of your money, it's your fund money, you just kind of, you're throwing educated darts at the wall pretty much.
For sure. Yeah. I mean, if ETFs or ETFs, mutual funds, index funds weren't a thing, I would be more, in depth. I would have, 5 or 6 bullet points that, hey, this company has to hit this before I would buy it, kind of thing. What I'm looking at as far as an overall portfolio is I want 10% growth, and then I want, roughly 1.5% in dividend payouts is what I look at. And that's what most of my mutual funds, index funds, things of that nature, that's what they do.
When you say growth, and are you talking about the dividend growth, or are you talking about like the total performance growth?
No, appreciation.
Okay.
Yeah, total performance.
Okay. Yeah, because I know, like, I think I talked about this in my last interview that's probably going to interview or premiere tomorrow at the time we're recording this. And we were talking about, like, how do we make dividend growth rate cool? Like, everybody on social medias and stuff, they're always sharing, like, what their yield is for their portfolio, and that's all good. But, like I said before about the patty, like that can easily steer people towards the, not necessarily right or wrong, but like to me, the wrong way of thinking about it is like, how can I increase this number as fast as possible? And that leads you down a dark path. Where if everybody started bragging about what their portfolio dividend growth rate is, I don't feel like there's that many negative consequences, if any, to like everybody focusing on the highest dividend growth rate possible. Cause I feel like that's just like it's the same thing as like, if somebody needs to be hydrated, and they're like, okay, I just need to be hydrated. It doesn't matter the liquid. But if somebody's like, hey, let's see how many cups of water you can drink a day. Yeah, it's possible to die off of drinking too much water.
Right.
You're probably not going to get there. Versus like the negative health effects of drinking too much Coca-Cola, as that being your only source of liquid. Like, I feel like that's kind of what we're getting at with like focusing on your dividend growth rate versus your yield kind of thing.
I got you.
So,
no, I 100% agree.
Yeah, I try to, like, my portfolio is a 10% dividend growth rate. Like, that's what I focus on as a whole. And it's, like you talk about with the price appreciation and compounding and all that stuff. Like, one of the ways to quote unquote get some of your time back is not only if your positions grow in capital appreciation, but my dividends growing at 10%, not including the money I'm putting in there. So the money I put in, the stock going up without me having to sell, and the dividend increasing by 10, 11, 12, 13% every year, regardless of the money I put in, like it's hypercharging the portfolio. So
yeah, that's a winner right there.
It is. I like it. Okay. And then this is one of your last questions for you. So how important do you think staying diversified is when you teach that to your kids, as far as like, it could be between, stocks and bonds and real estate and crypto and all kinds of stuff like that, or just even specifically stocks? Like, do you value diversification? I know Charlie Munger was saying that it's, some people do diversification, where they just try to spread themselves so thin that they end up buying a bunch of crap that they don't necessarily need in the effort to stay diversified. So where do you stand on that?
No, diversity is a huge proponent of managing the risk. When it comes to managing risk in your investment portfolios, there's really 3 things you can do. You have more time, like you said, for the last 120 years, however long the stock market's been open, 99% of all 10-year periods have been positive in the stock market. So the longer your time horizon is, the much more likely you're going to be profitable, make money, see growth, things of that nature. Diversification, again, the more companies you have in a basket. That's why I'm such a huge proponent of like S&P 500 index funds or growth funds, because think of it as a basket that's got between 100 and 500 of great quality companies, that's going to give you, if one of those companies goes to zero, it's just going to be a blimp on your radar versus if you've got single stocks and, you've got that one company goes to zero where you lose all the money that's invested in that stock. And the great thing about the S&P 500 is it cleans itself every quarter. There's 1 to 2 companies that fall out and 1 to 2 companies that join. And then the holding percentage, the total value of that fund, as far as like each individual company, will go up and down depending on the growth of each company.
Yeah, I'm actually doing research for like the broad market indexes, just for a video I'm going to do later. And one of the questions did you know the S&P 500 has 503 stocks in it?
Yeah, because I know Alphabet has two share types.
Yep.
And then I forgot the other company. There's another company that has multiple share types.
Yeah, there's 3 total that have 2. It's like double shares. It's like different classes of the shares. It's Alphabet, Fox. It's Fox
right.
A and Fox B or something like that. And then it's News, like News Corp.
Gotcha.
And I was also looking at what you're talking about, like staying diversified. As far as like News Corp, I think is the smallest one in the S&P 500. When you have 500, and I speak about this with my portfolio too, because I have 11 positions. I have 11 positions at 100%. They don't want you to have more than 5% in any one holding. Well, that the math quite literally doesn't work out for that because I don't have enough holdings to be at 5% or less. So, and the S&P 500 is the same way. There are 503, technically 500 companies, but 503 holdings in the S&P 500. It's quite literally impossible for any of them to be, it's not impossible for any of them to be overweight, because you could argue that, Microsoft and Apple are overweighted. But like, if News Corp were to just blow up tomorrow and like, okay, we don't need News Corp anymore, we get all our stuff on social media or whatever. Everything's on Twitter. We don't need News Corp. News Corp is literally 0.1% of the S&P 500. So like, you would notice it, but that's only if everything else was closed and that went bankrupt. But like, if Microsoft goes up 0.1% and that goes down 1.1%, you're not even at that point, because Microsoft is more heavily weighted in the S&P than News Corp. So that is where diversification comes in. But like I said, I do understand, like for your individual holdings, it's also important. Like some people take it, and to my opinion, some people take it too extreme where they have individual holdings and they'll have 97 individual holdings. And I'm just like, I don't understand how you can manage that. And at that point, I feel like you're just trying to, I feel like you're trying to diversify too much, if that's a thing. I feel like there is a fine line between like being over diversified and under diversified kind of thing. But yeah, like to me, like, I don't know, people force themselves to buy companies or sectors that they don't necessarily like or understand just because they need something in that sector. Like, I don't have anything in communication services because I don't think it's a good sector. Like, you have your AT&T and your Verizon. I think both of them suck. Like, they're both high yielders that lose money, that cost a lot of money to maintain. Like, they have to constantly upgrade their towers, and they're always doing acquisitions and stuff. So, and then T-Mobile was the other one, and they acquired Sprint, which cost them money. And then T-Mobile was the only one out of the major cell phone providers that was actually making money, or like outperforming the market. And then, but they weren't paying a dividend. And now T-Mobile does pay a dividend. So I'm curious to see in the next 5-10 years if they start like going down to where AT&T and Verizon are, if they can still do what they're doing. But it's, yeah, I don't know. I diversification is really like a touchy subject, because some people I know personally are, 97 holdings and whatever. And like, that's perfect for them. It's not too much to manage. And then some people I know have 6 holdings. And they're not ETFs, like they're individual companies, but they understand these companies, they really value them. So,
yeah, I mean, if I had to guess, man, I probably got, just kind of looking through my portfolio here real quick, man, I've probably got 40 holdings, but some of those holdings are stupid stocks that I bought that have went down 80 or 90%. And I've got like, 5 shares each or 3 shares each. And I'm just waiting for it to get close to even. If it doesn't get close to even within a couple of years, I might just sell it and take the tax loss harvest and roll with it. But I mean, I've got probably 85% of my portfolio is in 3 holdings.
Yeah.
And then the other, 15% or the other, 35, 36 holdings or whatnot. So,
And that's your individual stocks?
No, that's everything.
Oh, okay.
Yeah, that's everything.
So how many in your brokerage account, do you know how many individual stocks you have?
Actual individual stocks, because I've got like some financial sector, ETFs, and I've got some, some dividend stock. I've got some dividend funds, and I've got actual individual stocks that I own, probably 10,
Yeah.
12 maybe,
So
like of actual individual companies.
so question for that. So when you own an ETF, for say the financial sector, do you is I don't know a lot of big words. Is that you conceding that there isn't an individual financial stock that you like enough to own individually, and you own the sector ETF instead, or do you also still own a financial stock in addition to the ETF for the sector?
No, I own XLF, which is it's a financial sector ETF. It all the banks and things of that nature, all the credit card companies and banks. And the only reason I own it is because I bought it at COVID when it was 45% off, and
Mhm.
now it's up. I mean, it's up like 158%, and I'm just holding on to it. It pays me a dividend every quarter, and I just roll with it.
So would you still own individual, like if you saw a really cool financial stock that's, it might also still be in that ETF, but like would you own that individually, or would you say, hey, I have enough exposure to the financial sector because I have this ETF?
I probably would. I'm a huge fan of American Express.
Okay.
I love Amex. I love their company. I have multiple credit cards. Like I put everything on their credit card and pay it off at the end of the week. I love American Express, and I think it's going to overtake, Visa and some of these other credit card companies as the top credit card provider in the next decade. I think the company's going to have a lot of growth. Customer service is exceptional. Their balance sheets check out. They're always creating more revenue, creating more profits. And American Express is a company that I'm pretty big on.
Well, I hope you're wrong because I own Visa, but we'll see.
Uh-oh.
And the thing is, like, I own Visa because when I was looking down to it, like American Express was third. I think Discover's fourth. But it was Visa, Mastercard,
Mhm.
American Express, and then Discover, and who knows other ones. But when I was looking at it, I literally just opened my wallet, and every card in my wallet was Visa, and I was like, okay,
Right.
like there's got like I know like Joseph Carlson's really big in like the financial space. I know he owns Mastercard, and I think they have slightly better performance over a relatively decent amount of time. But it was just like, okay, like everything I use is Visa. Anytime I walk by the doors and it's like, oh, we accept credit cards, the first one listed is always Visa, and I was just like, okay, like I think there's something to this. So it was one of those things. I did my research. Both of them were good. I didn't feel the need to own both of them. And I was like, okay, like somebody give me a sign of which one I should own kind of thing. So, yeah, I mean, I hope you make money off of yours. I just hope it's less than my Visa, just because
Yeah.
selfish reasons. You got the
I
VOO.
actually I actually don't own any shares of American Express yet. I do have it on I've got some saved ticker symbols,
Yeah.
that I have in my Yahoo Finance portfolio that I'm interested in. Because so I recently just got married like a month ago. So my wife and I
Congrats.
have been saving. Thank you. My wife and I have been saving for 6 months. Like we've been throwing every extra penny we can into our high yield savings account that makes 5%.
Yeah.
And to pay for the wedding and all the stuff that goes with that. Now that we've kind of gotten through that, we're about 5 weeks out of being married now, and we're gonna she's got about $2,000 left in her 2023 allocation for her Roth IRA because we completely stopped that. So then we're gonna make sure we get that done before April 15th, and then we're gonna start throwing into our 2024 allocation. And but I've got back to what I was getting at. I've got American Express saved as like a ticker symbol to watch, and I've got some notifications to where if it falls 5% or 10%, it'll send me a notification. If I see like a drop in it, I'm probably gonna jump in for a few shares.
There you go. We'll see. We'll have to stay in touch and see which one of the credit card. Because at the end of the day, the ironic part in that is credit cards make money off of people not knowing personal finance, and you teach
Mm,
personal finance.
right.
So you're just like, hey, I hope the people that I'm teaching are financially, smart and literate, know what they're saying. But I can't teach everybody, so I'm going to make money off the people that I
Right.
can't teach, kind of thing. So
78% of Americans live paycheck to paycheck.
yeah,
So there's more than enough people being bad with credit card debt. Now,
yeah,
I'm a big proponent. I tell people all the time, credit card use is not a bad thing.
yeah.
Credit card debt is because average interest rate on a credit card in America is almost 20% today.
I thought it was
So
actually higher than that. I feel like both of my
it,
credit cards, and some of them have like variable interest rates or whatever, but I feel like one of them's like 24.9 and the other one's like
mhm,
27. But like, and you probably tell your students this too, the number doesn't matter if it's zero. Like going
correct.
back to simple math, 27% of zero is zero, 55% of zero is zero. So it doesn't matter.
Correct. Yeah,
Yeah.
I pay my credit card off at the end of every week. On
Yeah.
Friday, I make a payment.
Yeah, I have a Fidelity Visa card and that I opened because it gives you 2% cash back, and the 2% cash back goes directly into your brokerage account. So at the end of the month, I just get an extra, 60, 70, $100 added to my brokerage account that I can invest. And like, to me, I'm like, that's money I was going to spend anyway, that I'm now getting 2% back on, that I'm going to invest at 10% returns, and it gives me a 1.6% return off of the S&P 500 or whatever it is. I'm like, it's just compounding money I was going to spend anyway. I wish I could put like my mortgage on it. Like I would just put literally like, I don't have a car payment or anything, but my biggest bill every month is my mortgage. I'm like, okay, there's $800 every month on there. But
Yeah.
again,
I've definitely entertained some ideas like that. Back when I was still a renter, like, hey, is there a way I can put my rent on a credit card and get, 1.5% cash back, or my mortgage or something like that? And there are companies that will do it,
yeah,
that will somehow do that, but you pay a fee.
Yeah.
And the fee is like, 3 to 5%, and it just doesn't mathematically make it a good idea.
yeah, that's what we need to write something to the government. Hey, let us pay our, but like to your point, 78% of people are living paycheck to paycheck. What would happen is the amount of people, like, it's hard enough when you go into like collections with your credit card, or you go into foreclosure on your house. Imagine both of them happening at the same time, because you're
For
paying your
sure.
mortgage on your house. So, or you're paying your mortgage on your credit card. So, that would just be like a big, like, at the end of the day, it's one of those things. I think it's a rule because people don't have the self-control and the discipline to actually do it right. So,
For sure.
for the, 20% of us that would actually be really savvy with it. And I think that's where Dave Ramsey, I hear him say all the time, I've never seen any millionaire brag about their credit card reward points or get rich off of credit card rewards or anything like that. And I like that you listen to him, but you can also have your own opinion, because some people just blindly follow everything he says. And I'm just like, it's not about getting rich off of them. It's about like, can you take advantage of this without it taking too much of your brain power? And like I do, I just literally, any money I spend, I use. And advantages of using a credit card versus a debit card is like the fraud protection, where if it comes directly out of your bank account, you're kind of screwed. But if it comes out of a Fidelity card, or not a Fidelity card, but a Visa or a MasterCard or whatever, they have all kinds of protections and guarantees and stuff like that you can use to shield yourself from any kind of frauds or anything. So.
Yeah, I mean, like you said, I get between $50 and $75 cash back from my American Express card every month, and is $50 is not a lot of money, but if you give it to me, I'll put it in my pocket.
Yeah, I'm like, yeah. I it's going back to what we were saying. I think right before we started the interview about like how we have nobody to like talk dividends to. Now, good thing for you is you get to express your financial self in your classes. I don't have a class. This is my class, so
Gotcha.
I just talk about it to the regular everyday person. And like, even with my dividend portfolio, like you said, it was cool that you said your first year you made like 20 something. My first year was like 2377 or 2398 or something like that. So about the same thing. And nobody cared about that. Nobody cared about the 104 I made the next year. Nobody cared about the 253 I made the following year. But eventually there will become a point where somebody's like, how are you making $36,000 a year off of something you're not doing? Like a part-time job that you're not working. And I don't know what that point is. I haven't reached it yet. But eventually somebody's going to be like, wait a minute, you're making like, cause right now, even this year I might make, $2,000. It's my fifth year in dividends, which I think is pretty good. I don't change. My portfolio yields like 2.1% or something like that. So pretty low. And like, I don't think people are going to care about that either. $2,000 for a whole year. Like, my buddy will be like, oh, I made that in a week. Like, cool. But like, you worked for that. He's also like blue collar, like plumber or stuff like that. I'm like, I literally woke up and made $2,000 for no reason. So, okay. So you being in the finance space, both on social media and in person in schools, I'm sure you hear a lot of myths or misconceptions. So this is probably a perfect question for you. Are there any myths or misconceptions around investing or dividends specifically that you hear, or maybe your kids bring up? Hey, I thought investing was this, or I thought personal finance was this. Are there any of those that you hear all the time that you always have to debunk?
I mean, not necessarily from my school, but I grew up in a really small town in rural South Carolina. And most people don't know what the stock market is. They don't know about investing. They're scared of it. They don't understand it. And people think investing is too risky. I mean, and granted, there has to be some risk that goes into it, but where comes a little bit more risk comes a possibility of a greater return. The stock market is going to go down 2 out of every 10 years, but it's going to go up 8 out of every 10 years. If you look at all the stats and the numbers, like the stock market will always go up and to the right. Are there going to be some small blimps in it where it goes down? Yeah, you got 2008, 2020, 2022. But if you look at the long haul and you invest in a long period of time, like the stock market will go up and to the right. It's virtually guaranteed. And one thing that I firmly believe in is if you buy into the S&P 500, and people always say, well, what if you buy the S&P and it goes to zero? Well, if the S&P 500 goes to zero, you're not worried about your stock market account, because
Yeah.
bottled water and ammunition is going to be the currency of the world. It's going to be like freaking the purge.
Yeah. 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 Well,
So
so how do we, and again, you have a great, and to a certain extent, I have a great platform for this too with the channel, and you have like the actual day to day with your students. How do we express, because everybody always talks about the risk of investing in the stock market. How do we express the risk of not investing in the stock market?
Well, I mean, do you want to be eating Alpo when you're 70 years old because you don't have any money saved for retirement? Or do you want to be living a decent lifestyle and being able to enjoy life with your grandkids and pay for their college? And, because everyone is going to get to a point in their 60s or 70s where they're going to get tired of going to work. Their back's going to be hurting. Their knees are going to be hurting. They're not going to want to get up and work a job. And don't ever rely on the government to support you. Like, I've got members of my family who strictly live off Social Security. You get, a little over $1,000 a month, and that is their entire income. And I just couldn't imagine,
Mm-hmm.
Even in a small town where I come from, I couldn't imagine living off $1,000 a month, especially in an inflation type environment that we live in. It's 100% solely up to you to invest for your future and save for your retirement. Giving up a little bit of today for a great, big, beautiful tomorrow.
Yeah, yeah, and that goes back to the delayed gratification and everything that we were talking about. And like I said, it seems like fear is like the thing that drives everything now. It's like, whether you look on YouTube and it's everybody putting fire behind their faces and shocked faces and all kinds of stuff like that. So like to me, the fear should be like, oh my gosh, look what your life's gonna look like if you don't do this. Like it's not like, oh, you need to sell this stock because it's gonna go down or whatever. Like I see so many people that are, and like part of the groups that we're in on Facebook, how many times do you hear people saying, oh, the market's really expensive right now, I'm holding off. And like going back to what you're saying, 8 out of 10. And like sometimes it's, 7 out of 10. Like maybe we have three bad times in a decade period, but sometimes, like you said, it was 08. So it was what, 2000 and 08. There was 7 years in between that. Then there was from 08 to 2020. So there was nothing in that period. So it's just kind of like the 2010s had nothing. It was all good. So it's not even like a 2 out of 10 guaranteed. It's just on average, it's 2 out of 10. And to me, the people that just constantly plan for the bad years, I'm like, you're missing the point. Like, yeah, you might be able to buy something a little bit cheaper that one time it goes down. But what happens is this company A will go up 100% in 8 years. It'll go down 30%. In that 1 year with the quote unquote, the crash or whatever, and they're thinking that they're getting a deal at 30% off. I'm like, yeah, but if you would have bought it, back in year 1, year 2, year 3, year 4, it was still cheaper than you're buying it for today. And instead you're just over here hoarding all your little acorns waiting for the rainy day to come. And I'm like, why would you plan if you're in Phoenix, Arizona, and you're planning for the rainy day? Like you go out and you spend $1 million a year on umbrellas and rain boots. Is that really a good use of your time and money? Like you're in Phoenix, like, yeah, it's going to rain maybe sometime, but like, that's not a thing that happens all the time. So I just thought of that analogy. I thought that was pretty good.
Yeah. I mean, and the third thing, I don't think I mentioned it earlier. The third thing when it comes to managing risk is dollar cost averaging, buying in the, once or twice a month, same day every month, regardless of the market. If the market is going up, you're making money, right? The markets are green, you're making money, your portfolio is growing. And then in times on red days when the market is going down, you're having an opportunity to buy quality assets that you like at a cheaper price. You're lowering your cost basis. So I'm a huge proponent of dollar cost averaging. Like I put in, my wife and I, we put in almost $4,000 a month on the 1st and 15th of the month, every single month. And regardless of the market. And then in times like in 2022, right, in Q3 and Q4, when the stock market was down, I think it was down like 16 or 18%, whatever it was, I increased my 401k contributions to like 48 and 50 something percent in the last half of 2022 to buy the S&P 500 at a 16, 18, 20% discount. And then, 2023, we know the market went up, 20, 22, 24%, whatever it was. And then now the S&P's up 7-8%, I think, so far this year.
Yeah.
So, just always constantly be buying. If the market goes down, buy more, especially if you're invested in, index funds and S&P 500, things of that nature. Just keep buying, man, because you're going to get to retirement and it's going to be a beautiful chunk of money there that you're going to live off of, and you're going to be able to change your family tree and things of that nature.
Yeah. Yeah. I agree with that. It's I don't know. I mean, you said it perfect. I have a video that I made that talks about that same thing. And it's not necessarily clickbait. The idea was to get a lot of people to look at it because it's so crazy to think, but it was literally like why I believe stock price doesn't matter. And the
Right.
two reasons were, one was fractional shares, because like it doesn't matter if something, Chipotle, before they do their 50-1 split. Chipotle, I don't own Chipotle, but if I wanted to own Chipotle, I don't care whether it's a 50-1 price or if it's the current price of $3,000. Doesn't matter, because I can buy $10, $100, $1,000. I can buy whatever I want of it and still get parts of that. That was one of them, and the other one was dollar cost averaging. Like at the end of the day, if you plan to hold for a long, now if you're 65 and you need the money at 67, one, like you really need to consider what kind of investments you're doing, but two, the price that you get it for now matters a lot more, because in the next 2 years it could go down 20% and you'd have to recover from that. But like that's where it changes. But like if you're in the part of your life where you have 10, 20, 30 more years to let it do something, like if you're buying a company and you're worried about, is today's prices going to be like, am I going to be underwater in this company in 30 years? You're buying the wrong stuff.
For sure.
Like
Absolutely.
that's what it boils down to. Like, I'm not worried. Everybody's like, oh, your Apple's down to 173. Are you worried? I'm like, is Apple going to be 173 in 30 years from now? Like if they do a split, maybe, but like, I'm not worried about it. So, okay. Last question for you. If you have every bit of knowledge that you have today, and you could go back to being 18 years old. So everything in the market's still the same. It's still 2024. You're just 18 years old. What are some tips and tricks for your younger self? What do you do different?
Start investing in your 401k Roth IRAs as early as possible. I was 18. I worked some in college, so I had some disposable income. And then early on in my working career, like I invested the bare minimum. I didn't have a Roth IRA early on. I just did a little 401k contribution. But just invest, because your wealth multiplier at 20 years old is 88 times over. Like invest, even if it's $100, $200, $300 a month. Yeah, at your younger ages, just invest. Like constantly be investing at a younger age. Like granted, I get it. The markets are at an all-time high right now, and sometime in the next year or two, we're probably going to be due for a slight correction, and it's probably going to happen. But just take advantage of the time you have, invest. Contribute, just giving up that little bit of today for a great big beautiful tomorrow is going to lead to prosperity. Your 60-70-year-old self is really going to appreciate your 18 and 20-year-old self for the contributions you made during those early working years.
Mm-hmm. Yeah, and the sooner you do it, the higher likelihood that you don't have to wait till 60 or 70. You could retire at 50 and 40 and whatever. Like my goal is like I said, I want to retire at 50. I already have an investing account for my kid who's 1. The goal is that he retire. Like I would be jealous if he retires before I do, not in age wise, but like if I'm 50 and he retires at 36, like I'd be a little jealous of that. I'm like, God dang it, I set you up too good. But
Right.
But it would be one of those things where like the goal is like, okay, if I can retire at 50, and even if he retires at 45 and he teaches the same stuff to his kids and they retire at 40. And eventually, like I talked about this in other interviews, eventually the cycle's reset. Somebody's going to get entitled. They're going to think they don't need to work, and their desire and discipline and stuff's going to fall off, and then they'll have to restart the whole thing. But that won't be my problem. I'll be dead long gone. So, but yeah, so I agree with that. It's about getting started. Like you said, with the correction, like everybody thinks the correction's going to happen, and the correction may happen, but it may not. And what you don't want to do is you don't want to hoard all your acorns and wait for the correction, because if it doesn't happen, then you missed. And you talk about losing your multiplier. You just missed. And it's not like for every year you lose 1x. That's not how that works. You get a lot more X's earlier in the journey, and you get a lot less X's later in your journey. So, yeah, I agree. I agree with that. It's so important to get started and just, get this ball rolling. You're not going to be rich tomorrow by getting Social Security. That's not how that works. So.
Yeah, I mean, and the key to financial prosperity is you want to be on the cover of Slow Money magazine.
Mm-hmm.
People are always, I want to get rich quick. I want to get rich fast. Well, that's a good way to get broke fast.
Yeah.
Kind of thing.
Yeah.
Trying to buy into speculative stocks or dividend stocks that have, a 20% payout and things of that nature. Like, there's a reason they're paying 20% because it's probably not a very good company and they're on some pretty bad financial times right now.
Yeah. Yeah. The little flash in the pan, like your little yield max funds and stuff like that.
Yep.
Yeah.
For sure.
All right. Well, Otis, it's been a blast. It's been a pleasure. I don't know how long we were talking, but I told you it'd be hard to keep it under an hour. So it was a blast. It was a pleasure. I had a great time learning about your journey and your impact on the youth in the area. So I appreciate you for that. If you have any signing off remarks, any places you want people to go to follow you, anything that you have, any content you produce, go ahead and the floor is yours.
Yeah, they can follow me on Twitter, X, as at Coach Mac HTX, all one word, COACHMACHTX, on Twitter, and I look forward to connecting and following.
Yeah, it's been a pleasure, man. And until next time, we'll talk to you later.
Take care. Thank you, Troy.
And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.